Welcome to the first video of the course on Advanced Financial Management. This training program consists of 20 modules devoted to the various areas within the interest of a financial officer at a multinational company. More specifically, these topics include the role of a senior financial advisor in a multinational organization, advanced methods of investment appraisal, mergers and acquisitions, corporate reconstruction and reorganization, and finally, treasury management as well as risk management techniques. In this introductory video, we will define the role and key responsibilities of a financial officer at a multinational company. We will also analyze how the activities undertaken by a financial advisor are connected with the strategy of the organization. Finally, we will briefly describe the essential aspects of financial management. The role of a financial manager is among the most important ones in every business organization. This is due to the fact that a financial manager is responsible for managing all of the financial actions of a company, which are aimed at increasing the wealth of shareholders. It is important to note that the decisions made by a financial officer impact numerous areas of a company's activity. These are not only limited to the company's finances, that is its profitability and cash flow generation, but are also closely linked to the fulfillment of regulatory requirements imposed on the company, as well as such issues as the ethical and environmental impact of the company's operations. We will be discussing these additional dimensions of a financial manager's responsibilities in separate modules of the course. To understand the role and functions of the financial manager, it is essential to note that they are in fact anchored in the company's strategy. Typically, in a business organization, the strategy stems from a policy framework that is a document governing the basic corporate decision-making processes, which specifies the criteria in accordance with which strategies are actually created. Clearly, the area of a company's policy framework which defines the roles and responsibilities of a financial manager is the financial policy. Nevertheless, other areas typically included in the policy framework are also linked to financial management. For example, in the area of ethics and social responsibility, which defines the role of the company with regard to its local society and the rules which the company will obey in its relations with individuals and communities. A significant portion of the relevant norms and requirements relate to financial management. Examples of such norms are ensuring fair and honest communication within the company and with its stake and shareholders, guaranteeing that complete and accurate information is disclosed to the markets, as well as compliance with finance-specific laws and regulations. Other roles of the financial manager relate to other areas covered by the policy framework, such as stakeholder protection, where it is the financial manager who is responsible for creation of value for shareholders and lenders. This is accomplished by evaluating investment opportunities and optimizing the firm's cost of capital. Another area, corporate governance, is also linked with the role of the financial manager, who is typically in charge of the company's financial risk management. That process is one of the cornerstones of the governance system in every company. As you can see, financial management, as realized by the financial officer, is associated with each and every one of the strategically important areas of a company's activity. In fact, financial management may be defined as planning the usage and management of a company's financial resources in order to maximize the wealth of the company's shareholders. Accordingly, financial management involves making financial decisions which are aimed at realizing those business objectives which are considered important from a strategic point of view. The list of tasks which typically fall under the responsibility of a financial manager in a corporation is in fact quite long. It encompasses areas such as the selection of investment opportunities, management of financing costs, and pursuit of the company's earnings retention and dividend distribution policy. A financial manager is also responsible for financial budgeting and control, as well as managing financial risks. These responsibilities also include communication with shareholders and creditors. Let us now take a closer look at these areas, starting with investment selection and capital allocation. In light of the fact that the goal of any business is to maximize shareholder value, the need to undertake appropriate investment projects is clearly a critical issue. The selection of investment opportunities is obviously aimed at maximizing the returns achieved on the capital invested, that is, the financial resources provided to the company by shareholders and creditors. The methods applied in this evaluation are predominantly of a quantitative nature, such as discounted cash flow and simulation techniques. You should be aware, however, that investment selection is rarely just about the maximization of financial gains, and that's because creating company value implies much more than just generating earnings. Accordingly, the selection of investment projects requires, among other things, an analysis of the fit of the investment with company values. So prior to undertaking any investment, a company has to assess its ethical and environmental impact, which may potentially be detrimental to the company's reputation and, as a result, have a negative impact on company value in the long term. One of the factors which must be taken into account in the investment selection process is the scarcity of resources and capital, due to which companies are not in a position to finance all of the investments which have a positive outlook. The use of scarce resources has to be rationed so that these are only applied in order to undertake profitable projects that represent the best possible fit with the company's mission and strategy. Raising finance and managing the financing costs of a company is yet another aspect of financial management, and one which is closely linked to the selection of investment opportunities which we just discussed. Obviously, financing is necessary for a firm not only to undertake new investments, but also to facilitate its everyday operations. Managing a company's sources of finance is carried out in the short run with the goal of optimizing the firm's working capital and cash management policies, and in the long run with the goal to equip the company with sufficient and sustainable sources of debt and equity financing. One of the key issues which occupies financial managers in this respect is the optimal level of gearing, that is, to what extent the company should be financed with debt instruments, such as issued bonds and bank loans. The factors which are typically taken into account in deciding on the capital structure of a company are not only the costs associated with the various sources of finance, but also tax issues, risk profile preferences of the company's management and its shareholders, the perception of market analysts, as well as external restrictions such as regulations and debt covenants. A company's distribution and retention policy is yet another essential element of financial management. It is linked to both the policy on investments as well as the optimization of financing costs. The main dilemma faced in the formulation of the distribution and retention policy is whether free cash flows generated by the company should be retained by the business and reinvested or distributed, in other words, paid out to shareholders. The answer to this dilemma depends primarily on the preferences of shareholders, but also on whether the company does indeed have prospective investment opportunities which are worth pursuing. From this angle, the distribution policy should endeavor to answer the question of which of the two possible uses of cash accumulated by the company will best contribute to the creation of company value. Another important area of financial management is the management of financial risk. According to the majority of finance theories, risk is a factor which has a twofold impact on business activity. On the one hand, it may lead to adverse changes in market variables, resulting in a financial loss. On the other hand, it may also be a source of favorable changes, thus generating upside potential. From this perspective, each company has to determine the level of risk it is willing to accept, referred to as its risk appetite. Carrying out the provisions of a risk management policy by the financial manager of a company requires keeping the relevant risk factors such as currency risk, interest rate risk, and credit risk within the limits determined in accordance with the risk appetite of the company. As we will discover in the further modules of the course, effective risk management requires the monitoring and measurement of risk, as well as dealing with risk by means of mitigation, hedging, or diversification. Financial management cannot be effectively conducted without adequate planning and control. These areas of financial management are based on a company's management accounting system, whose principal role is providing management with financial plans and budgets, as well as controlling the company's finances and evaluating its performance. The last of the cornerstones of financial management, which we need to mention in this video, is communication with the company's stakeholders. The goal of such communication is to keep both external stakeholders, such as shareholders, creditors, governments, and customers, as well as internal ones, such as employees and the management, informed about the financial condition of the company. Stakeholder communication is effected via different channels, including published financial statements and management reports. Companies listed on stock exchanges are additionally required to submit reports on significant matters and corporate actions taken by the company. Conversely, internal communication is effected by means of reports distributed directly to those groups of stakeholders at which they are aimed. As you can see, the scope of financial management duties which lie within the responsibility of a financial officer is very wide. The general goal of a financial management is to ensure that the company's resources are appropriately employed in order to generate value to shareholders and stakeholders of the firm. It can be concluded that any financial decision made by a business organization should conform with the so-called 3E principle. In accordance with this rule, the use of resources has to be economic, meaning that it has to minimize the cost of resources required to achieve a certain business goal. Efficient, that is, ensuring that the business goal has sufficient value in comparison with the cost of the resources employed. And finally, resources have to be spent effectively, that is, in a way which ensures that the use of resources will lead to achieving the assumed objectives. The 3E principle can additionally be supplemented with a fourth component, which is transparency, ensuring that all spending is appropriately recorded, controlled, and reported. In this course, we will be analyzing the various areas of financial management so as to familiarize ourselves with the techniques used by financial managers in the realization of their tasks. Welcome to the first video of the course module dedicated to the formulation of corporate financial strategy. In this module, we will be discussing issues related to the financing of companies and investment projects, such as the optimization of capital structure and financing costs. We will also explain the need for a sound financial risk management framework in an organization. In this video, we will focus on how the financial performance of an organization may be assessed using ratios as well as their trend over time. As you will surely appreciate, the evaluation of a company's financial performance is crucial not only from the perspective of formulating an appropriate financial strategy, but it is an essential part of financial management in general. Ratios relating to an organization's profitability, liquidity, gearing and market value, as well as their evolution over time, can help explain changes in the way the company is perceived by investors. They may also signal that the financial strategy adopted requires adjusting. In just a few moments, we will review the ratios which are most commonly used in financial analysis and illustrate their computation and interpretation using a sample balance sheet and profit and loss account. The first area of financial performance which we will focus on is profitability. Among the most commonly applied profitability ratios is the return on capital employed, usually referred to as ROCE. It is typically computed as the profit before interest and taxes, or EBIT, divided by the capital employed being the sum of equity and long-term financing. An after-tax version of ROCE is also used where the tax shield effect is included in profit before interest before dividing it by the capital employed. Let's now calculate the ROCE using the sample financial statements. In year 1, the ROCE before tax is calculated as the profit before interest of €500 divided by the sum of bonds issued of €1,000 and total equity, which amounts to €2,330. Accordingly, the year 1 pre-tax ROCE comes in at 15%. When the same calculation is performed using year 2 numbers, the result is 17%. The after-tax version of ROCE for year 1 is calculated as the profit before interest of €500 multiplied by 1 minus the corporate tax rate of 30%, which is subsequently also divided by the capital employed, producing a result of roughly 11%. After-tax ROCE computed in respect of year 2 amounts to 12%. Return on capital employed shows a company's efficiency in using capital, and as you can see, in the analyzed case, this efficiency improved year on year when viewed from both a pre-tax and after-tax perspective. Another profitability ratio which is commonly used to assess the performance of a company is the operating profit margin, measuring the proportion of revenue left after covering the costs directly associated with generating this revenue. So, in year 1 of the analyzed case, the operating profit margin is computed by taking the gross profit of €1,900 and dividing this number by the total sales of €5,400, which gives a result of 35%. In year 2, performing a similar computation reveals an operating profit margin of 40%. The interpretation of these results is that the company made 35 cents in profit before fixed costs, interest and taxes on every euro of sales. This amount grew by 5 cents over the course of the second year. Knowing that the profitability of the company has been improving, let's now inspect how its liquidity position changed over the same period. To do this, we will concentrate on ratios relating to working capital management. The first ratio which we will be analyzing is referred to as debtor days, or the receivables collection period. It shows the average number of days which the company needs to wait to receive cash from its trade receivables, and is calculated by taking trade receivables from the balance sheet, dividing them by the revenue achieved from sales on credit terms, and multiplying the result by 365 days. In the analyzed example, it is not apparent what portion of the revenue comes from sales on credit, so we will assume that the entire revenue generated was subject to deferred payment terms. Accordingly, to calculate debtor days for year 1, we divide the balance of receivables amounting to €350 by revenue of €5,400 and multiply the result by 365, which gives 23.7 days. When we compute the same ratio in respect of year 2, we receive a result of 16.6 days, which means that in the second year the company was able to shorten the average time needed to collect cash from invoices issued. Let's now see if the terms of payment made to suppliers are also showing signs of improvement. To assess this, we need to calculate a metric known as creditor days, which is also referred to as the payables payment period. Creditor days show the average period after which the company pays its suppliers. So the higher or longer this ratio is, the more financing the company receives from its suppliers. Creditor days are calculated by taking the balance of payables, dividing it by the purchases made, and multiplying the result by 365. Using the cost of sales as a proxy for the amount of purchases, year 1 creditor days are calculated as payables of €280 divided by 3,500 euro from cost of sales and multiplied by 365 days, which gives 29.2 days. Creditor days computed in respect of the second year equal 38.7 days, which means that year on year the company managed to obtain significantly more favorable payment conditions in its relations with suppliers. However, similar increases may also be a sign that the company is falling back on its payment obligations due to a liquidity crunch. Finally, we can calculate the inventory holding period, which shows the average number of days for which the company maintains items of inventory, raw materials, work in progress, as well as finished products or goods held for resale. This measure is obtained by taking the balance of inventories, dividing it by the cost of sales, and once again multiplying the result by 365. Performing this computation reveals a drop in the inventory holding period from 83.4 days in year 1 to 77.4 days in year 2, which represents a significant improvement. All three of the liquidity measures which we just discussed may be combined into one indicator known as the cash operating cycle. This metric shows the length of time which on average elapses between the payment for inventories acquired and the receipt of cash for goods and services sold. It is calculated by adding debtor days to the inventory holding period and deducting the number of creditor days. In the analyzed case, the cash operating cycle shortened from almost 78 days in year 1 to 55.3 days in year 2, which suggests a substantial improvement in the company's liquidity position. The third group of ratios typically used to analyze financial performance relates to gearing, in other words, the level of the company's indebtedness. If gearing is too high, then the company may find it difficult to service its debts, as it may simply generate insufficient cash to repay the interest on loans and bonds issued. Gearing may be assessed from the perspective of the balance sheet as well as the profit and loss account. The balance sheet gearing ratio is calculated as an entity's debt divided by its equity, or alternatively as the proportion of debt in the total capital employed, that is the sum of debt and equity. In the analyzed example, in year 1, the first type of balance sheet gearing ratio amounts to 43%, that is the €1,000 of debt divided by €2,330 of equity, and the second type amounts to 30%, which is derived by taking the same €1,000 of debt and dividing it by the overall level of capital employed, that is €3,330. In year 2, the ratios come in at 35% and 26% respectively, showing a decline in the level of balance sheet gearing between the years. Let us compute the profit and loss gearing ratio, which will allow us to assess whether the company's profits are sufficient to cover the burden created by interest payments. In order to do this, we need to calculate the so-called interest cover, being the ratio of profit before tax to interest for the year. So, for year 1, we divide the profit before tax figure of €500 by interest of €110 to reveal a result of 4.55. The same ratio computed in respect of the second year comes in at 7.5, which is a sign that the company's potential to service its interest payments increased over the period analyzed. So far, we have been discussing ratios which relate to the company's reported financial statements. In all of the areas which we have investigated, that is profitability, liquidity and gearing, they have shown signs of improvement on a year-on-year basis. This suggests that the company's perception by investors should also be improving. In order to verify this proposition, we may analyze some ratios of a stock market nature. Please note that these ratios can only be calculated for entities whose shares are listed on a stock exchange. The stock market ratios which are most often used comprise the price-to-earnings ratio, dividend cover and dividend yield. The first of these, generally referred to as the P/E ratio, shows the relation between a company's share price and its earnings per share. Dividend cover is the ratio of an entity's earnings per share and its dividend per share and shows the portion of earnings that are paid out in the form of dividends. And finally, dividend yield represents the relationship between dividend per share and the share price. In the example analyzed, there is no information concerning dividend payments. In fact, when we compare the balances of retained earnings as reported at the end of years 1 and 2, we note that the entire profit booked in year 1 has been retained by the company, implying that no dividends were paid out to shareholders. Consequently, we are unable to calculate neither the dividend cover nor the dividend yield. We may, however, analyze the P/E ratio. To do so, we need information on the number of shares, which equals 1,000, and the relevant share prices. Let's assume that these stood at €1.40 and €2.25 at the end of year 1 and year 2 respectively. So the PE ratio for the first year is computed by taking the share price of €1.4 and dividing it by the profit achieved for the year on a per share basis. So that's €273 divided by 1,000 shares, which yields a result of €5.13. The same ratio computed in respect of year 2 comes in at €6.18. Once again, this represents an improvement and is a reflection of increased shareholder confidence in the company. As you can see, ratio analysis allows for a relatively easy and quick assessment of the financial performance of a business. Additional insights are gained when trends in ratios are analyzed across periods. Ratio analysis can be used by both shareholders and market analysts to assess the performance of entities listed on the stock market, but it is also applied by companies internally for the purpose of formulating and assessing financial strategies. Welcome to the second video of the course module devoted to formulating financial strategies. In this video, we will explore the concept of an optimum capital structure, which is without doubt one of the key elements of a company's financial strategy. The goal of this video is to acquaint you with the basic concepts related to the choice of a company's sources of financing, which will be further expanded on in further modules of the course. As you already know, raising finance and minimizing the cost of a company's capital are among the key roles of a corporate financial manager. A company's financial strategy has to allow the business to finance its existing and planned investments using an optimum mix of the two main sources of finance, that is equity and debt. From the perspective of generating company value, the optimization of capital structure is one of the key factors which impact shareholder wealth. Probably the most important issue associated with corporate financing is a company's level of gearing, a factor which enables the organization to lower its cost of capital. You should appreciate that the choice of a specific capital structure in a company is tied to the inherent trade-off between the advantages of debt, which is usually the cheaper form of financing, and the risks associated with a high level of gearing. From this perspective, finding the optimal proportions of debt and equity to be employed allows the company to minimize its overall cost of capital and thus maximize company value. Let us now consider how gearing impacts a company's cost of capital. The overall cost of capital is the average cost of all sources of finance used, which include both equity and debt. However, there is a major difference between debt and equity as sources of finance. As you know, shareholders assume the overall business risk associated with a company's operations and only receive variable remuneration in the form of dividends when the company is generating profits. On the other hand, a company's lenders or holders of its debt instruments are promised a fixed or determinable level of remuneration in the form of interest, which the company must pay regardless of profitability. Given the higher level of risk taken on by equity holders, the rate of return expected or required by providers of equity financing should be higher than the rate required by debt holders. As a result, debt is typically considered a cheaper form of financing than equity. The difference between the cost associated with debt and equity financing is also associated with yet another important consideration, namely that the return available to shareholders is subject to corporate income tax, whereas the remuneration paid out to debt holders in the form of interest typically constitutes a tax-deductible expense. Therefore, gearing allows a company to enjoy the benefits of a tax shield, which has the effect of further reducing its average cost of capital. On the other hand, however, Financing by debt implies that the company assumes an obligation to pay interest to its lenders, regardless of financial condition, which obviously increases the overall riskiness of the business. This is due to the fact that the more indebted a company, the higher the portion of its revenue needed to cover interest payable, leaving the company with less flexibility in the case of worse than expected performance, and leaving shareholders with even less hope for profit, which could be distributed to them in the form of dividend payments. As a result, when gearing is particularly high, shareholders require a premium, an additional return to cover the increased risk which they bear. As you can see, gearing has the potential to affect a company's average cost of capital in a twofold way. Until it reaches a certain level, that can help lower the cost of capital due to its lower cost and associated tax shield effect. Beyond that point, however, gearing will increase the average cost of capital due to the increasing risks associated with the company becoming overly indebted. As you may expect, there is no simple method of finding that optimum point. There are a number of theories addressing this issue: the Modigliani-Miller theory, static trade-off theory, or the so-called pecking order theory. We will be exploring them in further modules of the course. There are a number of practical issues which companies consider when formulating a strategy with respect to debt financing. Let's take a look at them now. The first issue relates to the availability and cost of debt. The market for debt, both for loans and bonds, is subject to fluctuations. There are periods in the economic cycle when banks are less willing to grant loans to companies and potential investors less inclined to purchase bonds. In addition, the more a company is leveraged, the more expensive it may be to issue additional debt. This is obviously due to the fact that lenders perceive such companies as more risky and thus demand a higher return on fresh debt offered, via increased interest margins levied by banks and higher yields required by bondholders. Another aspect of debt financing associated with the cost side of borrowing is the impact that debt has on the overall level of costs incurred by a company. This relates primarily to the ongoing interest cost, but also the cost of issuing debt, which may become significant, although it is typically lower than the cost of issuing new shares. Speaking of interest, we should also note that company value may be exposed to the risk of adverse changes when the debt issued is a floating rate instrument. In such cases, rising rates of interest in the market will increase the level of interest paid by the company. In order to manage this risk, companies typically hedge the exposure to variability of interest payable by fixing its level, for example using interest rate swaps. It should also be mentioned that debt financing is usually more accessible to well-established companies which generate stable revenues sufficient to service debt obligations. Consequently, issuing debt is generally seldom an option considered by startups. The optimum financing strategy for a company is also connected with the tax regime of the jurisdiction where the company operates, as this clearly impacts the value of the tax shield from which it may benefit. With tax considerations being among the main drivers of debt financing, the higher the tax rate in a given jurisdiction, the higher the tax shield benefits that may be achieved as a result of taking on debt. Finally, we should not forget that issuing new debt requires convincing shareholders that increasing the leverage of a company will generate additional value to them, in particular when a company's articles of association contain restrictions regarding the level of gearing allowed. Similar restrictions, referred to as credit covenants, may also be included in debt agreements already in place. As you can see, Achieving the optimum capital mix is a crucial element of a company's financial strategy through which the cost of capital may be minimized and shareholder value created. We will be exploring the topic of cost of capital as well as the various theories of capital structure in further modules of the course. This video covers distribution and retention policy, which is another crucial aspect of strategic financial management in a company. We will start our analysis by first discussing the theoretical stance on the irrelevance of dividends. Next, we will present arguments showing why this theory does not hold in practice. Finally, we will review the main factors which companies take into account when formulating their dividend policies and analyze typical practices in this field. The classic view on dividends, developed by Miller and Modigliani, states that it should be irrelevant to shareholders if they receive dividends or not, as long as the company invests its retained earnings in projects with a positive net present value or NPV. The rationale for this irrelevance assumption comes from the fact that if a company invests retained earnings at the rate of return required by shareholders, then a missed dividend should be matched by an equal increase in the company's share price. So, assuming that the rates of return on projects into which the company reinvests its profits are higher than the rate of return expected by shareholders, then reinvesting should increase shareholder wealth. Therefore, in accordance with this theory, it is the company's investment policy that is most relevant to the creation of shareholder wealth, not its dividend policy. Although the theory sounds rational, you should be aware that it is based on a number of simplifying assumptions, which, among others, pertain to the irrelevance of external factors, such as taxation and the costs of issuing equity. When these assumptions are relaxed, the theory becomes invalid. This relates in particular to the issue of tax rates on capital gains and dividends, which in certain jurisdictions may differ, a fact which has obvious implications for shareholder preferences. There are also other arguments which undermine the validity of the irrelevance theory in imperfect financial markets. In reality, investors have specific preferences regarding corporate dividend policies. In particular, certain investors may favor current income, which they can use to finance current consumption needs. Such preferences are typically observed with reference to individual investors. However, institutions may also require a regular dividend stream to service their current obligations. As a result, there is a broad group of investors who prefer to hold shares of those companies which pay a regular dividend. Another argument against the irrelevance theory is a common belief among investors that a dividend is a safer form of income than a capital gain. That is because the realization of a capital gain requires selling shares, which exposes investors to share price variability. Finally, market participants often use dividend payments as sources of information regarding the financial performance of a company. This effect is referred to as dividend signaling. As you can see, dividend policy is clearly not irrelevant. In fact, a dividend policy is one of the key elements of any corporate financial strategy. Let's now discuss the factors which companies take into account when deciding on their policies regarding dividend payouts. The first of these is dividend capacity, which is understood as the ability to pay dividends to shareholders. First and foremost, dividend policy is a function of a company's profitability and the availability of free cash flows. Generally, the more stable the earnings of a company, the greater portion of its profits may be paid out to investors. Dividend capacity also depends on the availability of other funding sources. If a company is not in a position to issue debt to finance its investments, it will be forced to a greater extent to rely on retained earnings as a source of finance, and as a result, its dividend payouts will be reduced. This relates in particular to fast-growing companies, which typically reinvest their entire earnings. It should also be mentioned that the ability to pay dividends may be subject to specific regulatory limitations across jurisdictions and industries. Such limitations may relate to maintaining a certain level of profitability, as well as minimum levels of capital below which entities are not allowed to pay dividends. Other factors impacting dividend policy relate to the economic environment in which a company operates. One of the most important aspects is the level of inflation. This is due to the fact that dividends are based on the historic profitability of a company, typically the after-tax profit for the year preceding the dividend decision. Therefore, paying out dividends in periods of high inflation may lead to the erosion of a company's capital. Let's now review some common examples of dividend policies adopted by companies. The first policy is one of stable dividends, under which a company pays out a fixed or growing dividend each period. Such a policy is particularly attractive to investors with a strong preference for predictable current revenue, and is typically adopted by mature companies with stable profits. Please note that under this policy, a company may find it difficult to maintain a stable level of dividend in periods of reduced profitability. A specific type of stable dividend policy is the so-called ratchet pattern policy, where dividends are paid out with a time lag relative to the earnings achieved, which allows for the level of dividend per share to be maintained even in periods of temporary decreases in profits below the dividend level. Another dividend policy is associated with maintaining a constant payout ratio, under which a company pays out a constant portion of earnings achieved each period, while the remainder of those earnings gets reinvested. Under this policy, the level of dividend per share will naturally fluctuate from period to period. On the contrary, under a residual dividend policy, the company pays out only the residual portion of earnings, which is not reinvested in the company's investment projects. The major drawback of this policy from the point of view of shareholders is an even lower predictability of future dividend levels than in the case of a constant payout ratio. On the other end of the spectrum of dividend policies is the zero dividend policy, where no dividends are paid out to investors as the entire profit is retained and reinvested. This policy is often favored by companies during the growth phase and ought to be changed when the company's business matures and cash starts to accumulate. As you can see, the choice of any particular policy listed is associated with a trade-off between the ability to preserve cash for reinvestment and the fulfillment of investors' expectations regarding the realization of current profit. There is, however, a dividend scheme which allows for a reconciliation of the two needs, and it is referred to as a scrip dividend. A scrip dividend is a scheme under which an investor may choose between receiving a cash dividend and being awarded new shares of the company. Accordingly, those investors who have a lower preference for liquidity and who believe in the value creation potential of the company's investment projects will choose to receive shares, whereas investors with a preference for current income will rather opt for a cash dividend. Please note that scrip dividends allow shareholders to increase their capital involvement in the company without incurring brokerage costs. A potential disadvantage of scrip issues is that when used excessively, they may potentially lead to the dilution of ownership. Finishing our discussion on dividend policy, we have to mention share buyback schemes as an alternative to paying out dividends. Share repurchases are typically carried out when a company has a large cash surplus that cannot be invested in an NPV positive project, and management decides to return this cash to shareholders. Obviously, this surplus could be paid out in the form of a dividend, but a share buyback has a number of advantages, both for shareholders and for management. The most important argument in favor of share buybacks from the perspective of management is that a share repurchase increases the company's share price, by which the company sends a positive signal to the market and also becomes less prone to a takeover. What is more, the shares which are bought back get cancelled, which increases the company's gearing ratio and impacts its cost of capital. From the shareholders' point of view, a buyback gives them the option to either sell their shares back to the company and realize a capital gain, or not sell and profit from future increases in the share price. Please note, however, that a share repurchase has to be allowed by a company's Articles of Association and usually requires consent to be granted by the general meeting of shareholders. As you can see, there are various approaches to dividend policy applied by companies, and different policies are adopted by organizations which are at different stages of corporate development. In other modules of the course, we will explore the topic of dividend capacity and learn more on developing a suitable dividend policy given a company's specific circumstances. Welcome to the fourth video of the module devoted to the formulation of financial strategies. In this section, we will be dealing with the topic of risk management. To begin with, we will explain the rationale for a risk management policy in a company. Then, we will focus on the most important elements of an organizational risk management framework. We will end the video with a discussion of the different approaches to risk management, such as mitigation, diversification, and hedging. As you will already know, risk management is among the key responsibilities of a financial manager in a company. As you can imagine, controlling and managing risk is a costly process, making it essential to understand the rationale for risk management. According to the theory of risk management, the role of corporate risk management is to assure that the risk factors to which a given business activity is exposed do not damage the business effort connected with this activity. To put it another way, risk management is all about maintaining the uncertainty at a level which is acceptable by an organization and its shareholders. As you know, risk and return are positively correlated, which means that investors generally require higher returns on more risky projects. However, after reaching a certain level of riskiness, the increased return does not counterbalance the probability of a project's failure. Thanks to a risk management system, an organization is in a position to select those investment opportunities which provide the level of return required by shareholders without taking on excessive risk. So, risk management may be considered a measure which supports the creation of a company's market value. From the point of view of relations between the shareholders and the management of a company, risk management is a tool which helps ensure that management are taking investment decisions that are in line with the expectations of shareholders. In theory, investors should be well diversified and should decide on investing in the shares of a particular company based on its risk profile and how those shares match their existing investment portfolio. Without an effective risk management system, management could be tempted to take decisions which maximize their own value rather than shareholder value. From this perspective, an organization's attitude to risk, commonly referred to as risk tolerance or risk appetite, is the instrument which provides the relevant linkage between the investment decisions of management and the requirements of shareholders. Let us take a closer look at the notion of risk appetite, which may be defined as the overall level of risk that an organization accepts in pursuit of its business goals. Although the definition is very simple, determining the exact appetite for risk is complex and difficult. Thus, risk appetite is often declared by companies as a statement of approach whose goal is to establish a common understanding of risk throughout the organization. It is essential that the maximum tolerated risk be defined and understood before any management decisions are taken in the area to which the risk is inherent. This relates in particular to making strategic investments, but may also pertain to day-to-day operations. As you will appreciate, risk appetite differs across industries and organizations. For example, companies whose activities may have an impact on public safety, such as nuclear power plants, are characterized by a low level of risk acceptance, whereas startup businesses typically manifest a high tolerance for risk. When defining its risk appetite, an organization has to consider the volatility of the industry in which it operates, seasonality of the business, and competitiveness of the market. The key dimensions of a risk policy are the target level of operating and financial leverage of the organization, as well as the degree to which the company will rely on forecasts and projections in its investment decisions. In order to properly address all material risk factors, an organization establishes a risk management framework which embraces the process of risk identification, assessment and monitoring, as well as strategies for dealing with risks identified. Please note that from the perspective of evaluating investment projects, risk assessment is largely dependent on the quality of estimates used to forecast the outcome of an investment. Accordingly, the risk framework in this area should put particular emphasis on the awareness of factors which could affect projections, as well as the quantification of their probability and impact. The risks related to forecasts in an investment project may be classified as strategic, tactical, and operational. Strategic risks are the ones that affect the overall direction of a project, such as macroeconomic and political changes, while tactical risks, such as changes in the supply chain or in the timing of payments, impact only a significant part of the project. Operational risks are the ones connected with the day-to-day management of the investment project, for example, the risk of breakdowns in equipment. A potential approach to the management of those risks can be based on designing appropriate measures to deal with risk factors, depending on the likelihood of occurrence and significance of impact. Please note that such an approach requires defining detailed criteria for the categorization of risk factors and their updating as work on the project progresses. The effective monitoring of risks is not possible without reliable information. Therefore, a company's information systems play a key role in the risk management process. The primary function of those systems is the collection of data on identified risk factors and on actions taken by managers at the appropriate level of the company's hierarchy. Systems also aggregate the data and make possible its presentation in different cross-sections. There are two types of information systems used by companies. The first is the Management Information System, referred to as MIS, which provides operational data allowing a company to make decisions regarding identified risk factors and perform detailed risk analyses. The second type is the Executive Information System, referred to as EIS, which provides more high-level and summarized information regarding the key aspects of risk management to the senior executives in the organization. The internal audit function also plays a significant role in risk identification. Even though internal audit is not operationally involved in this process, the findings from audits and reviews conducted by the internal audit function may provide valuable information regarding the organization of a company's systems for risk identification and management. The final element of the corporate risk framework encompasses strategies put in place to deal with the risks already identified. In this respect, there are a number of approaches which companies may apply, ranging from the acceptance of the risk to its complete elimination. The strategies most frequently adopted include the mitigation, hedging, and diversification of risk. Let's briefly discuss them one by one. Risk mitigation is an approach to risk management in which the impact of risk factors is reduced as a result of implementing control procedures. The goal of a controls system is to prevent, detect, and correct potential risks before they materialize. As you can imagine, building and maintaining an extensive system of controls is expensive. Therefore, it is usually put in place to help a company defend from the most routine and frequently occurring risk factors. For non-routine risks, companies typically apply other approaches, such as hedging. Hedging is a strategy where a risk factor is neutralized by means of a transaction which creates an exposure to the same or similar risk as the hedged exposure. As you should already know, hedging is typically applied to manage financial risks, such as currency risk and interest rate risk, with financial derivatives used as hedging instruments. Diversification means reducing the impact of a given risk factor by including and mixing a number of different investments in one portfolio. As a result of negative correlation between the investments selected, the overall risk exposure of the portfolio is lower than the sum of the risk exposures of the individual investments. The approach to risk management can be summarized in the so-called 4T framework, in which, depending on the level of likelihood of occurrence of a risk factor as well as the severity of its impact, a company can apply one of the 4Ts, namely tolerate, transfer, terminate, or treat the risk factors. For risk factors of low likelihood and low impact, a company may choose to simply tolerate the risk. If a risk factor is of low impact but its occurrence is highly probable, a company may decide to treat it by applying either a controls system or hedging against it. The way to deal with risk factors characterized by high impact and low likelihood is to transfer the risk to another entity, for example using insurance contracts or by passing the risk to counterparties. An example of transferring risk comes in the form of issuing invoices in the company's local currency, thanks to which the currency risk is passed on to the client. Finally, the only way of dealing with risks which have both high impact and a high probability of occurrence may be their termination. Here, termination means removing the source of the risk factor, which is the investment to which the factor is inherent. As you can see, a risk management system in a company is a complex structure encompassing a long process starting with the determination of the company's risk appetite, moving on to the formulation of a risk policy and the building of risk information and control systems, and ending with decisions regarding the treatment of identified risk factors. It should be remembered that risk management cannot be considered a static process. This is due to changes in the economic environment in which a company functions, where new risk factors may constantly emerge. Thus, a modern approach to risk management should be a dynamic process where risk policy is continuously adapted in response to altering economic conditions. In this video, we will continue discussing the topic of risk management in a company, and will concentrate on specific types of risk to which organizations are exposed in their international activities. Those risk types are political risk, economic risk, regulatory risk, and fiscal risk. In just a moment, we will attempt to define each of the risk types and present how companies can manage exposures resulting from those risks. Political risk is associated with the instability of government in the country where a company decides to locate a subsidiary. This risk is defined as the negative impact of decisions taken by local policymakers on the value of a company. Examples of extreme cases of political risk include the outbreak of war or the expropriation of a company's assets by a foreign government. However, the spectrum of threats to companies located in foreign countries is much broader. Examples of these include imposing tariffs or quotas on imported goods, or restrictions regarding the remittance of cash to the parent company, as well as special rules on the dividend policies of foreign entities. Local governments may also implement discriminatory regulations aimed in particular at foreign investors, such as limitations on access to local financing sources or super taxes imposed on foreign firms. Political risk may be divided into micro risk, which relates solely to a given industry or sector, and macro risk, which affects all foreign companies present in a given country. Due to its complex nature, there is no way to measure political risk. However, there are rules which companies interested in locating a subsidiary in a given country may use in order to assess its level, such as the information provided by rating agencies. An alternative approach to the measurement of political risk involves the use of quantitative methods based on macroeconomic modeling or real option valuation. Another method used by organizations considering locating an investment in a given country includes consulting experts such as academics, diplomats, or businessmen already present in the local market. A measure which is often applied before an investment decision is made is a grand tour, which is an inspection of the locations considered, tied to meetings with local government and aimed at gaining an understanding of the specifics of doing business in a given country. Finally, companies may use information provided by commercial political surveys, which assess the level of political risk of countries on a numerical scale, based on questionnaire data. Such survey-based information is, for example, offered by Business Environment Risk Intelligence or the Political Risk Services Group. Management of political risk has two aspects. The first one includes actions that may be taken by a company prior to investing in a country, and the second one consists of measures which a company may put in place after a subsidiary has already been set up. Among the actions typically taken in the pre-investment phase is the signing of a pre-trading agreement with the government of the host country. The aim of such an agreement is to contractually regulate and thus stabilize the factors which are deemed critical to the functioning of the subsidiary, such as rules related to dividend policies and the remittance of cash flows. It should be noted, however, that there is a risk that pre-trading agreements may stop being recognized in the case of a change of government, which may be a frequent occurrence in unstable host countries. Another way to reduce political risk in the pre-investment phase is by transferring it to another entity via an insurance policy, such as export credit guarantees. After a subsidiary has been set up in a country, the investing group typically attempts to stabilize the level of political risk by managing its relations with government and market participants in a way that will discourage local policymakers from taking decisions which could negatively impact the foreign entity's business. The aim is to convince decision makers that the local economy, society and government actually profit from the presence of foreign investors in the country. This may include emphasizing such factors as contracting local resources and labor and obtaining funding via local financial markets. On the other hand, companies may also take actions aimed at lowering the value of their overseas subsidiaries as perceived by local governments in order to deter them from attempts to expropriate those subsidiaries' assets. Such actions include locating critical value-adding production stages in the home country, holding control over distribution networks, and protecting intellectual property with international patents. Moreover, companies may finance their subsidiaries via international financial markets, which should protect assets from expropriation because a potential default in the servicing of debt would expose the local government to criticism from international financial institutions. Another type of risk which is connected with overseas investment is economic risk, defined as the volatility of a company's value due to changes in the macroeconomic environment of the host country, including factors such as economic growth, recession, and unemployment rates. Having said this, the single most important factor which influences economic risk is the level of the exchange rate of the local currency, which directly impacts the profitability of imports and exports of a foreign company, and in particular the level of dividends and other cash remittances made to the parent. Although it is similar to transaction risk, economic risk is typically not hedged with derivatives, but rather managed through the diversification of supply, distribution, and financing sources. As you can expect, when a company's sources of supply as well as its buyers are spread across different geographical locations, then the negative impact of the weakening or strengthening of one currency should at least to some extent be offset by an opposite change in the rate of another currency. Similar effects may also be observed when the sources of a company's financing are diversified internationally as well. Regulatory risk is similar to political risk because it materializes through decisions of local policymakers regarding specific requirements relating to a given industry or market. New regulations may be of a general nature that is related to all entities in a given jurisdiction, such as anti-monopoly laws, or of a specific nature, which means that they are aimed at certain industries only. For example, new regulatory requirements related specifically to the banking sector or to health services. There is no simple recipe for managing regulatory risk. Typically, companies maintain compliance teams which analyze planned and announced regulatory requirements and assess their impact, project the necessary implementation actions, and compute the cost of conforming to the new laws. Alternatively, companies may hire external consultants to perform these tasks. A similar approach is applied to fiscal risk, which represents the uncertainty related to unfavorable changes in taxes levied in a country where an overseas subsidiary is located. Management of fiscal risk includes primarily keeping track of changes in a country's tax system and making sure that the policies followed are up to date. As with the management of regulatory risk, this may either be done in-house or be outsourced to external tax consultants. As you can see, the spectrum of risks associated with the presence of an organization in a foreign market is wide. These risks are interconnected and complex in their nature, which is particularly true for political and economic risk. You should appreciate that the list of risks discussed in this video is far from exhaustive. In fact, the range of risks to which firms are exposed in their international activities is widening. Terrorism and computer network security are examples of risk categories whose importance in investment decision-making has recently been on the rise. We must therefore keep in mind that risk management is by its nature a dynamic process where risk exposures should constantly be tracked and analyzed and policies updated. As we have already mentioned, the risk types which we discussed in this video cannot simply be hedged, as is the case with market risks. The management of these exposures must be part of a company's strategic decision-making process, rather than relying on a day-to-day management approach. In the last video of the module devoted to the formulation of financial strategies, we will be dealing with behavioral finance and its impact on financial strategies. In previous videos, we discussed the key themes related to the financial strategy of a company, such as sources of financing, dividends, and risk management. When describing those aspects, we emphasized their role in the process of creating company or shareholder value, with the underlying assumption being that investors are rational and logical in their decision making. In particular, we typically assume that investors analyze all available information coming from the market before deciding whether to invest into or divest out of the debt or equity instruments of a given company. However, anomalies such as cycles, bubbles, and crashes, which are frequently observed in the stock market, suggest that this is not always the case in reality, and that under some circumstances, market participants fail to act in a rational way. Possible sources of such irrational behavior are suggested by behavioral finance, a field of study which attempts to incorporate lessons from psychology and cognitive sciences into traditional economics. According to behavioral finance research, decisions made by investors are more often taken based on emotional and psychological mechanisms rather than the analysis of facts and available information. A typical example of such mechanism is herd behavior, causing investors to mimic and blindly follow the decisions of others and giving rise to such market anomalies as excessive booms and crashes. It seems that herd behavior is a manifestation of another well-known psychological effect, namely overreaction to information, such as media reports on upward trends in a given market. It has been psychologically proven that human behavior is subject to significant biases of various kinds. Examples of biases which typically influence the decisions of investors are confirmation bias, where the investor has a predetermined conviction and only pays attention to arguments which support it, and hindsight bias, where the investor believes that a certain, in reality unpredictable event was obvious and could have been forecasted. Consequently, hindsight bias makes the investor overconfident, which may lead to erroneous decisions in the future. Another behavioral scheme which may impact investors' decisions is referred to as gambler's fallacy. Here, the investor is similar to a gambler who believes that a series of negative results increases the probability of scoring a win, while in fact the probability of statistically independent events is not impacted by history. As a result, investors tend to, for example, maintain their investments in assets whose prices are plummeting, in the belief that the downward trend is bound to reverse. As you can see, there are several psychological mechanisms influencing the behavior of investors. As a result, prices of shares may change due to factors independent of the actual financial position of a company. A question arises if behavioral finance should be reflected in the financial strategies of companies. However, the question has no simple answer. Obviously, financial managers should be aware of behavioral factors influencing share prices. certain elements of a financial strategy, such as, for example, decisions regarding dividend signaling, may take into account the findings which come from the study of behavioral finance. However, we have to remember that the main objective of financial strategic management is the maximization of shareholder value in the long term, and the effects of behavioral finance are typically observed in the short or medium term only. Welcome to the video devoted to the ethical dimension of the decisions made by a financial manager in a business organization. As you already know from the module devoted to the role of the financial manager, the financial decisions of a company can impact many areas both inside the organization and within its wider economic environment. As a result, unethical decisions which may seem beneficial from the point of view of a company's profitability may simultaneously have a negative impact on certain groups of stakeholders, such as local communities, suppliers or employees, and therefore may ultimately have a negative impact on the company itself, for example, through adverse publicity. So, unethical decisions can prove detrimental to the process of value creation by a business, and it is therefore essential that companies incorporate the assessment of ethical considerations into their decision-making processes. It is important to note that all corporate actions have to be ethical, not only at the individual level, but also at the level of the organization and society as a whole. This means that it is not only the individuals running the business who have to apply ethical principles to themselves and their own behavior, but also that the entire organization has to exercise its legal and other obligations with respect to all groups of stakeholders, as well as towards other parties and social groups not directly associated with the company. Accordingly, at a corporate level, ethics is the way a company approaches potential stakeholder conflicts and corporate governance. Like all other decision makers in a firm, it is essential that a financial manager ensures that all actions and decisions taken within the confines of their area of responsibility are ethical and properly anchored in good governance practice. The ACCA Code of Ethics is a set of fundamental ethical principles which have to be followed by any professional holding the ACCA title. The code may naturally be used as a guideline to support the decision-making efforts of all financial managers. The main principles contained in the ACCA Code of Ethics are integrity, which relates to being honest and straightforward in all business relations, and objectivity, that is, avoiding biases, conflicts of interest, and other external influences which could potentially take precedence over professional business norms. What is more, the ACCA Code of Ethics requires members to apply professional competence and take due care of all matters assigned to them. This means that finance professionals are obliged to maintain an adequate level of professional knowledge and skill, ensuring that their decisions are properly grounded in current finance, legal and technical developments. Finally, the code obliges members to respect the confidentiality of information acquired in the course of professional relationships, implying that they may not disclose such information to third parties unless disclosure is required by law or regulation. In particular, no confidential information may be used for personal benefit, such as insider trading, or for the benefit of third parties. A company's approach to ethical issues associated with financial decision-making should be included in its financial policy, regulating the behavior of all finance professionals working for the company. In other words, an ethical financial policy should incorporate a code of conduct typically covering such points as acting in accordance with the ACCA principles and disclosure of any possible conflicts of interest to a company officer in charge of ethical issues. An ethical financial policy should also ensure that the company's financial practices, including accounting, internal controls and auditing, meet the highest standards with respect to honesty and transparency, and that they comply with external norms and regulations. What is more, an ethical financial policy should promote ethical behavior among all employees and encourage personnel at all levels of corporate hierarchy to constantly increase their level of knowledge and awareness of best practices. It seems obvious, however, that even the best financial policy will not ensure a company's ethical behavior unless financial decisions are made in accordance with it. In order to encourage employees to apply the policy and its principles to everyday decision-making, a company may put a number of measures in place. First of all, employees should confirm that they actually understand the company's ethical principles and commit to act in accordance with them. Furthermore, a company may provide employees with additional guidance related to the practical application of ethical norms in real business situations and designate other resources such as hotlines with the aim of helping employees make ethical decisions. Finally, a company should implement mechanisms requiring employees to immediately report all cases of potentially unethical actions taken within the firm. Welcome to the course module devoted to ethical and governance issues associated with corporate financial management. In this video, we will be dealing with so-called agency problems, resulting in the potential for conflict between a company's management and its stakeholders. We will also describe typical corporate governance measures which are applied in order to minimize the risk of such conflicts occurring. In subsequent videos of the module, we will explain the concept of integrated reporting and discuss the ethical and environmental aspects of financial management in a business organization. Let's start by defining what an agency problem actually is. As you know, the main goal of any business organization is the maximization of shareholder value. However, shareholders represent just one group of a company's stakeholders. Other groups include the company's creditors, customers, employees and local communities, whose interests should also be taken into account in the company's decision-making processes. In many cases, the objectives of different stakeholder groups may in fact be contradictory, and this may result in conflicts which have to be resolved by the company's management. A particular type of conflict, referred to as the shareholder conflict, is the one between the owners of the company and its management. The reason for this conflict stems from the separation of management from ownership. Typically, shareholders do not participate in the day-to-day management of the companies which they own, as this responsibility is handed over to professional managers who should act in the best interests of shareholders and other important stakeholder groups. However, as practice indicates, in certain situations, managers tend to act in their own best interest with the goal of maximizing their own wealth instead. It is interesting to note that agency problems exist not only in commercial organizations, but also in non-profit institutions such as foundations and healthcare service providers. Although it may be expected that the morale of managers and employees in such organizations is higher than that found in strictly commercial entities, psychological research shows that acting in one's own self-interest is an immanent feature of human nature. It may therefore be concluded that the agency conflict can never be entirely resolved or eliminated. However, measures exist which can be put in place in order to reduce its impact. These include, in particular, performance-based compensation of managers and increased shareholder participation and influence when it comes to making strategically important decisions. We will be dealing with these measures later on in this module. Let's now take a closer look at some typical examples of conflicting interests among certain groups of stakeholders and the costs to the organization which they cause. A typical example of stakeholder conflict is the one that arises between shareholders and providers of debt financing. Shareholders expect higher returns than debt holders and may therefore apply pressure on management to undertake more risky projects. Debt holders, on the other hand, prefer projects generating lower risk because the return on debt financing is typically fixed, or at least not dependent on the ongoing performance of the business. This conflict generates increased agency costs to the company, such as those associated with loan covenants, which may restrict further borrowing, the payment of dividends, or asset acquisitions and disposals. Another example of agency problem is the conflict between employees and shareholders. For example, employees may oppose the automation of certain manufacturing processes for fear of losing their jobs. The costs of such opposition may take the form of strike action initiated by employees, but also loss of savings which the shareholders had planned to achieve from the automation. Conflicts may also arise between stakeholder groups which are not directly associated with the firm, for example, a company's customers and local communities. An example of such conflict arises when customers apply pressure on the company to reduce prices. The company may react by squeezing its local suppliers, thus exposing itself to negative publicity and unfavorable perception from local communities. As you may imagine, stakeholder conflicts are difficult to manage because the interests of certain groups are often completely contradictory. A commonly applied measure which enables the management of these opposing interests involves establishing a set of rules which define the hierarchy of decision-making referred to as corporate governance. Corporate governance may be defined as the way in which a business organization is directed and controlled. Its primary goal is to protect the interests of stakeholders and to ensure that the company as a whole acts in accordance with its values and ethical norms. The basic idea behind corporate governance is to balance the interests of a company's stakeholders, including shareholders, management, customers, suppliers, providers of finance, government and the community, by providing a decision-making framework which allows for the realization of the company's business objectives. Within the corporate governance framework, decision-making authority is distributed among the management and stakeholders. In particular, certain types of decisions may be taken by individual executives or the full board of directors, while others require the consent of the general meeting of shareholders. What is more, certain decisions may be handed over to dedicated committees within the company. In some companies, the rules of corporate governance also require that certain key decisions are consulted with other stakeholder groups, for example, employees. Let's take a closer look at how a corporate governance framework may be set up in a business organization. Typically, operational matters are decided upon by individual executives. For example, the Chief Financial Officer makes decisions regarding everyday financial management matters, the Production Manager regarding operational matters, and so on. However, Individual executive directors are only allowed to decide within defined limits, and all decisions exceeding those limits have to be taken at a higher level, for example by the full board of directors, to ensure that the views of all executives are taken into account when such strategic decisions are made. Some matters are exempted from the decisive power of the board and handed over to non-executive directors, forming the organization's committees. Contrary to executive managers, non-executives are independent of the company and can more accurately exercise their judgment in areas where executives could potentially experience a conflict of interest, such as management remuneration or accepting internal audit reports. Key corporate decisions, such as initiating new investment projects, appointing directors and external auditors, are typically reserved for the shareholders of a company who can vote on such matters at the annual general meeting of shareholders. As you can see, corporate governance is all about spreading the responsibility for company management by including various stakeholders in the decision-making process in a way which allows for the adequate handling of conflicts of interest, which could otherwise occur between different stakeholder groups. However, as you may expect, even the best corporate governance systems may fail without adequate monitoring actions taken by management and appropriate reporting, ensuring that decisions made within the organization are congruent with its strategy and values. Welcome to the second video of the module devoted to ethical and governance issues. In the previous section you got acquainted with the notion of stakeholder conflict and the concept of corporate governance. In this video we will be discussing the methods used to evaluate management performance. As you may expect, the directors of a company tend to act in accordance with the expectations and requirements of shareholders, providing their performance is monitored and evaluated. Management appraisal is typically based on an assessment of whether the targets which they were assigned were achieved or not. In many institutions, manager objectives include a mix of both financial and non-financial goals. Financial targets used in management appraisal may refer to accounting ratios or stock market figures. Examples of the first are earnings per share or return on capital employed. It is worth noting, however, that application of such metrics to the appraisal of managers has been subject to criticism because measures such as earnings are not directly linked to shareholder wealth. Use of the dividend per share ratio eliminates this drawback. However, it should be noted that there are situations in which dividends are not paid out, while shareholder wealth still increases. For example, when a company reinvests its profits in investment projects with positive NPV. In such cases, linking management evaluation to dividends is obviously inadequate. Some companies incorporate even more sophisticated measures into management appraisal, such as economic value added or EVA, which is a more accurate measure of shareholder wealth because it takes into account the capital structure of the company. Examples of stock market metrics used to evaluate managers are the price-to-earnings ratio or simply the company's share price. Again, use of such measures is far from perfect, and that's because share prices may fluctuate in reaction to external factors, which may be independent of the decisions taken by the company's management. A measure which is better suited to the appraisal of managers than accounting and stock market ratios is shareholder value added, referred to as SVA, which specifically measures the improvement in cash flows generated by a company for the benefit of its owners. It should be noted, however, that the computation of SVA is a complex process, and this has a negative bearing on the popularity of this approach. As a result, the majority of companies do not build their management evaluation schemes solely on financial metrics, but incorporate non-financial measures into the process as well. For example, management evaluation may be based on a balanced scorecard, which allows for the assessment of a company's performance from various angles, which include, apart from financial results, other perspectives such as customer satisfaction, the level of innovativeness, quality of business processes, and many other, depending on the company's mission and characteristics. You should be aware that management appraisal does not necessarily have to be linked to ratios and measures which relate to the company as a whole. Many firms assign their managers individual targets connected strictly to their area of competence and responsibility. These targets can either take the form of specific cost or revenue objectives or non-financial targets, for example, linked to employee satisfaction ratings or staff turnover. Let us now concentrate on the way companies report their results to the public. Depending on jurisdiction, a publicly traded firm has to periodically issue a set of information to the market. Such a set typically comprises the financial statements, which in many countries have to comply with international financial reporting standards, as well as non-financial reports, as required by local commercial law and stock exchange regulations. Naturally, the main goal of financial statements is to provide information about the financial situation and performance of the reporting entity. However, financial reporting frameworks such as IFRS also require companies to disclose a great deal of qualitative information, allowing readers to learn about other aspects of their performance, such as how they are managed, how they approach environmental issues and social responsibility, and many others. In the final video of the module devoted to governance and ethical issues associated with financial management, we turn our attention to the environmental aspects of business activity. In recent years, the damage caused to the environment by humans has become one of the most critical issues facing the global community. Most scientists today agree that emissions caused by carbon-fueled business operations contribute to the change observed in the planet's climate. That is why more and more emphasis has lately been put on the impact that business activity has on the environment. The idea of environmentally responsible business is embodied by the concept of sustainable development, which is defined by the United Nations as development that fulfills the needs of present generations without compromising the ability of future generations to meet their needs. This definition implies that when running a business, managers should focus not only on economic performance, but also on its social and environmental impact, which ought to become an important part of corporate policy. As we already mentioned, one of the most significant impacts of business activity on the natural environment is the emission of so-called greenhouse gases, such as carbon dioxide, which contribute to the warming of the Earth's climate. The Kyoto Protocol, adopted in 1997 by 160 countries, which came into effect in 2005, set targets on greenhouse gas emissions applicable to individual countries, with the aim of reducing the global emission of carbon into the atmosphere to 5% below the level from the year 1990 by 2012. The Kyoto Protocol introduced a market mechanism to support the reduction of emissions referred to as carbon trading, under which countries issue emission permits to business entities, which can subsequently be traded in the market. As a result, companies can decide whether they prefer to invest in new, low emission technologies or to spend money on the purchase of additional emission certificates. What is more, many countries have set up their own environmental authorities with the goal of regulating and controlling the impact of business and its activities on natural resources and the environment. In particular, environmental authorities ensure that companies comply with domestic and international environmental norms with respect to the use of sustainable energy sources, recycling of waste, and protection of natural resources. In the UK, these tasks have been assigned to DEFRA, which stands for the Department for the Environment, Food and Rural Affairs. In order to enable companies to inform stakeholders about their approach to the issue of sustainable development, a system referred to as Triple Bottom Line or TBL reporting was developed. TBL is a reporting framework which requires that companies disclose not only how they create economic value, but also how social and environmental value is generated. This means that in order to comply with the TBL principles, companies have to prepare additional reports on social and environmental issues alongside traditional financial statements. This obviously requires setting up appropriate management reporting systems, enabling the capture and processing of relevant information, as well as ensuring that the information disclosed is true and fair. A possible way to ensure that the data which companies collect and process on the environmental impact of their activities is of satisfactory quality is to apply a framework provided by the ISO 14000 international norm. ISO 14000 is a family of standards which provide companies and organizations with practical tools to support the management of their environmental responsibilities. Among others, ISO 14000 requires companies to periodically audit their environmental management systems, thus ensuring that information disclosed to stakeholders is of sufficient quality. In particular, an environmental audit performed in accordance with ISO 14000 provides an assessment of whether the company complies with laws and regulations related to environmental obligations, as well as whether it acts in accordance with statutory requirements in this respect. An environmental audit additionally provides a tool for management to effectively control the environmental practices of the company. Other benefits of implementing an ISO 14000 framework include increased ecological awareness and commitment of the company's personnel, as well as an improved image of the company in the eyes of the public. Welcome to the next video of the module devoted to international trade, in which we will be talking about the importance of international financial markets to international trade. First, we will briefly describe the history of the international financial market and list its main roles with regard to international trade. Next, we will discuss the latest financial crisis as an example of how financial market developments may negatively impact companies. Finally, we will discuss issues connected with the free movement of capital and the measures taken against the financing of terrorism and anti-money laundering policies. It would be impossible for international trade to exist without the global financial system, which is a worldwide framework of agreements and institutions, facilitating the exchange of financial capital among entities participating in international investment and trade. The global financial system allows management of the world's balance of payments, which comprises all payments made and received by all countries. An important part of the balance of payments is the current account, encompassing, among others, the balance resulting from international trade. In the global balance of payments, some countries, such as China or Germany, have a current account surplus, meaning that they are net exporters, while countries such as the United States record a current balance deficit, implying that they are net importers. Accordingly, through the global financial system, countries with positive current balance in fact provide financing to countries with negative current balance. Global financial markets evolved in the 19th century in reaction to an increase in international trade, mainly triggered by the import of goods from colonies to metropolises. Since that time, global financial markets have recorded upswings and downturns. The latter were marked with the two world wars and the Great Depression of the 1920s. In more recent times, the years of greatest economic development, that is the 1980s and 1990s, in which the globalization of production accelerated, followed the decisions to free float the exchange rates of the world's major currencies following the oil crisis of the 1970s. Since then, a series of local financial crises took place in many regions of the world, including South America and Asia. These crises resulted in increased financial markets volatility. The last of the crises, which had an impact on global financial markets, was the credit crunch of 2008 and the Eurozone crisis, which started in 2009. Let us now discuss the mechanics and implications of both of these crises. The credit crunch resulted from excessive lending by American banks in the early 2000s. At that time, the American banking industry was over-liquid, and as a result, American banks found themselves pressured to extend loans to customers with a low level of creditworthiness and corresponding low credit rating, referred to as subprime loans. At the same time, a new cheap way of refinancing became available to banks in the form of securitization transactions. In a securitization, a portfolio of assets is sold to an entity referred to as a special purpose vehicle, which then issues debt securities whose risk is connected with the risk of the assets transferred. Such securities are known as CDOs, or collateralized debt obligations. A further mechanism called the tranching of risk made it possible to achieve high external ratings of CDOs, which were purchased by investors worldwide. In 2007 and 2008, subprime loans started defaulting, as a result of which the riskiness of CDOs, even of those tranches with high external ratings, grew dramatically. As a consequence, institutions who had been investing in CDOs recorded massive losses. The direct result of plummeting CDO prices was a near complete breakdown of the interbank financing market, which spread from the United States to other areas of the world, giving rise to a global financial crisis. The aftermath of this crisis included bankruptcies of several globally important financial institutions, some of which were liquidated and some saved by government intervention. What is more, in the years following the crisis, banks in all regions of the world became reluctant to grant loans, making it more difficult for companies to refinance their debts. In order to understand the mechanism which led to the outbreak of the crisis, let's take a closer look at the logic behind securitization. As we have already noted, the SPVs which purchased portfolios of assets from banks issued debt securities that were contractually linked to the credit quality of those asset portfolios. What this meant was that the contractual cash flows of the securities, that is their coupons and principal, would only be paid out if the loans backing those securities were in fact being repaid. In order to make the CDOs more attractive to investors and also to lower the refinancing cost in a securitization, the risk of the asset portfolios was unevenly spread across the different tranches of securities issued by an SPV. Junior tranches were subordinated to more senior tranches, implying that the holders of these subordinated instruments would only be paid off after the holders of more senior tranches had received all payments due. As a result, it was possible for the issuers of such instruments to achieve high external ratings and relatively low credit margin on senior tranches. In typical securitizations, the most subordinated tranche, accumulating the most risk, was in fact retained by the SPV. As one may expect, a securitization transaction functions properly as long as the assets purchased by the SPV generate enough cash flow to service the senior tranches of the CDO. What happened in 2007 and 2008 was a massive increase of credit risk in the assets backing the CDOs, as a result of which SPVs found themselves short of cash to service even the most senior of the tranches. Let us now examine a numerical example of a securitization and tranching. Imagine a portfolio of mortgage loans granted by a bank to its customers. The nominal amount of the portfolio is $100 million, and the assets generate a contractual income of 10% annually. The bank transfers the portfolio to an SPV, which will issue CDOs based on 90% of the portfolio, and the remaining 10% will serve as an additional credit support instrument in the transaction. The SPV will issue a senior tranche of $54 million in nominal value and with a coupon rate of 8%, a mezzanine tranche of $27 million and a coupon rate of 9%, and a junior tranche of $9 million and a coupon rate of 12%. In this transaction, the mezzanine tranche is subordinated to the senior tranche, and the junior tranche is naturally subordinated to the mezzanine tranche. So, the flow of payments in the transaction resembles a waterfall, where the proceeds collected from the loans first flow to the senior tranche, and when all payments due to holders of this tranche have been realized, then the flow is directed further down to the mezzanine tranche. Only what is left after servicing the mezzanine tranche will belong to investors in the junior tranche. Let us assume that all borrowers in the portfolio service their loans according to schedule. In such a case, the portfolio will generate $10 million of interest proceeds, calculated as $100 million of nominal value times the contractual rate of 10%. The senior tranche will receive $4.32 million of interest, calculated as the nominal amount of $54 million multiplied by the coupon rate of 8%. Then the interest on the mezzanine tranche of $2.43 or $27 million times 9% will be paid out. The remainder of the cash collected from the loan portfolio amounts to $10 million of total interest, minus $4.32 million of interest on senior debt, and less a further $2.43 of interest on mezzanine debt, which amounts to $3.25 million, can be paid out to the holders of junior debt. Please note that the $3.25 million represents the securitization's capacity to absorb losses, beyond which investors in the more senior tranches become affected. This capacity amounts to 32.5% or 3.25 million divided by 10 million of the total amount of contractual interest on the securitized assets. Thus, holders of the senior and mezzanine tranches are safe as long as no more than 32.5% of loan borrowers fail to repay their obligations to the bank. The most recent financial shock, which impacted the global financial system, began in Europe in the year 2009 and is commonly referred to as the Eurozone crisis. The origin of the crisis was Greece announcing that its fiscal deficit amounted to 12.7% of the country's GDP, compared to the 3% allowed for countries which adopted the euro as their currency. In consequence, investors started selling Greek treasury bonds, whose prices plummeted. Soon, Greece stood at the verge of bankruptcy. The crisis spread to other Eurozone countries suspected of having problems with budget discipline, such as Portugal, Italy, Spain, and in the later phase of the crisis, also Cyprus. In order to avoid the further spreading of the crisis, the remaining countries of the Eurozone, together with the IMF, decided to bail out Greece and other troubled economies, and the European Central Bank started purchasing their treasury bonds in order to stabilize the situation in the European banking system. Probably the most significant consequence of the Eurozone crisis is the downgrade of many European countries by rating agencies and the loss of confidence in the European Union, which also indirectly impacted a series of anti-European choices made in elections throughout member states, including the so-called Brexit, that is Great Britain's decision to leave the European Union. Let us now shift our attention to a different issue associated with international trade and the free movement of goods, services and capital in the international economy, namely the risk of using the reduced barriers to trade in order to remit funds for criminal purposes. On the one hand, the elimination of restrictions, in particular those associated with the free movement of capital, is a cornerstone of the global economy. On the other hand, however, it offers opportunities for criminals to pursue illegal activities, such as the financing of terrorism and money laundering. The term money laundering refers to a situation where illicitly obtained funds or assets are entered into the financial system as a way of concealing their link with crime. In recent years, global leaders have been working to adopt measures that would help identify and eliminate financial flows resulting from criminal activity. In 1989, the Financial Action Task Force, referred to as FATF, was established, which formulated recommendations on legal solutions aimed at the elimination of money laundering. According to these recommendations, companies have an obligation to monitor payments which they make and receive in order to ensure that they are not made in connection with criminal actions, and to report all suspicious cases to the local financial investigation unit. Participation in the remittance of funds coming from criminal activities, possession of and dealing with such funds, as well as concealing knowledge regarding such transactions by a company, are all considered a participation in crime. Anti-money laundering and anti-terrorism financing legislation has been implemented in most countries. An example of such legal acts is the Anti-Money Laundering Directive of the European Union. The ALM Directive, as it is referred to, generally fulfills the FATF recommendations. Its provisions impose a number of requirements on accountants of entities participating in the financial system, including, among others, identification of each client, reporting of all suspect financial activities, adequate record keeping, in relation to transactions and customer due diligence procedures. Welcome to the first video of the course module in which we will be dealing with the international aspects of business activity and in particular the international economic environment in which multinational companies operate. In this video we will discuss the theory of international trade as well as the most commonly found barriers to free trade. In further videos of the module, we will explain the role that the world's major international trade agreements, international economic organizations and banks play in global trade. We will also talk about international financial markets and analyze the negative aspects associated with the free flow of capital, such as the recent global financial crisis. According to a commonly used definition, a multinational company is any business whose revenues generated from sales to countries other than its home country exceed 25%. As you can see, many entities may in fact be considered multinational in light of this definition. In the case of all such companies, it is therefore essential to understand the global economic environment in which their international activities are pursued. Let us consider why companies decide to do business internationally, or to put it in other words, what are the reasons for the existence of international trade? The phenomenon of international markets may be explained using several concepts. The first is diversity. Not all goods may be produced in the domestic market of a country, and without the ability to buy imported goods, consumers would not have access to certain products. Another reason is competition. The fact that foreign companies can access local markets increases the level of competition in those markets, resulting in lower prices as well as boosting the innovativeness of local companies. Finally, economies of scale and specialization are further justifications for the emergence of international trade. As a result of manufacturing goods for both the domestic and foreign markets, companies can achieve economies of scale and, as a result, maximize their efficiency as well as offer more attractive prices than their smaller competitors. Specialization has a similar effect on efficiency and prices. Economic theory goes deeper, providing an explanation for why entities should specialize in the production of a given product and subsequently export it to other markets. The explanation comes from the comparative advantage theory as developed by English economist David Ricardo. According to his findings, individuals, companies and countries specialize in the activity in which they have a comparative advantage, as measured in terms of endowments or technological progress. Let us explain the law of comparative advantage using a simple example. Imagine an individual who has skills in producing shoes and making wooden chairs. During one working day he can either make a pair of shoes or one chair. His neighbor has similar skills, however is less endowed, and it takes him 3 days to produce a pair of shoes and 1.5 days to make a chair. Is there any reason for which any of the two producers should give up production of one of the goods and specialize in producing the other? Well, as you probably have noticed, the first individual has an absolute advantage in the manufacturing of both shoes and chairs, and the first impression may be that he cannot gain from specialization and trading with the second, less efficient individual. However, the answer changes when we consider the opportunity cost associated with production of the two goods by each of the individuals. Assume that a pair of shoes costs $250 and a chair costs $200. if both individuals stick to producing both goods, they will have to split their time between them. For example, during a working week of 6 days, individual 1 will spend 3 days making shoes, thus earning $750, and 3 days making chairs for a further $600. As a result, his weekly revenue will amount to $1,350, and the production output will be 3 pairs of shoes and 3 chairs. At the same time, his neighbor will devote 3 working days to make 1 pair of shoes, for which he will receive $250, and 3 days to make 2 chairs for $400. So his weekly revenue will come in at $650. The total production output of both manufacturers will therefore comprise 4 pairs of shoes and 5 chairs, and the total revenue of the 2 entrepreneurs will amount to $2,000. You should appreciate that by choosing to produce a mix of goods, neither of the manufacturers are maximizing their revenue. If individual 1 gave up making chairs and concentrated only on shoes, he could produce 6 pairs of shoes in a week, earning $1,500 instead of the current $1,350. Similarly, individual 2 could earn more money if he only produced chairs. In such a case, he would spend 6 working days making 4 chairs and earning $800 instead of $650. The reason behind the economies from specialization stem from differences in the opportunity costs faced by each of the manufacturers. For the first individual, the opportunity cost of earning $200 for 1 chair is losing revenue of $250 on a pair of shoes, which could also be produced in 1 day. So, for individual 1, the opportunity cost of making shoes amounts to 0.8 of a chair, or 200 divided by 250. By analogy, the opportunity cost of making a chair amounts to 1.25 of a pair of shoes, which can be calculated as $250 divided by $200. In order to calculate the opportunity costs for individual 2, we need to calculate his daily productivity for both goods. Knowing that he can make 1 chair in 1.5 days, his daily revenue from producing chairs amounts to $133.33. And knowing that he needs 3 days to make a pair of shoes, his daily revenue from shoemaking amounts to $83.33. So, the opportunity cost of making a chair amounts to $83.33 divided by $133.33. That is 0.63 of a pair of shoes, and the opportunity cost of making a pair of shoes amounts to $133.33 divided by $83.33. That is 1.6 of a chair. As you can see, despite individual 1's absolute advantage in the production of both goods, the opportunity costs of making the goods are different for the 2 producers. In particular, individual 2 faces a lower opportunity cost of producing chairs than individual 1, which means that he has a comparative advantage in making chairs over individual 1. Simultaneously, individual 1 faces a lower opportunity cost of making shoes than individual 2, which gives him a comparative advantage in shoemaking over individual 2. The theory of international trade assumes that the flow of goods and services among countries is in fact 3. Reality in this respect is, however, far different. In fact, for many countries, the import of goods from other, more efficient states is a threat to their local industries. Consequently, in order to protect their domestic markets, countries often impose restrictions on imports which form barriers to the development of international trade. Let's take a look at a couple of the most commonly used types of restrictions. The first type of trade barriers are tariffs, and quotas. A tariff is a tax levied on imported goods, with the aim of making imported goods less attractive to domestic customers in terms of price. A quota, on the other hand, is a limit on the quantity of goods that can be imported to a country over a period of time, and the goal of its implementation is similar to that of a tariff, in other words, limiting the impact of competitive foreign products on local business. Probably the most severe barrier to trade is an embargo, which is a complete ban imposed on goods imported from a certain country. Please note that an embargo is typically used as a tool to exert pressure on the political leadership of a country, rather than as a means of defending local markets. Nonetheless, from the perspective of a multinational company, an embargo is a barrier to trade, which is difficult to circumvent. Other types of trade barriers include exchange controls and administrative controls. Exchange controls are restrictions imposed on transactions in foreign currencies, aimed at limiting the volume of imports. An example may be a ban on using a foreign currency within a country, or limiting the amount of currency that can be imported to or exported out of the country. Typically, exchange controls are used by underdeveloped countries, as well as those countries whose economies are undergoing transition. Administrative controls are aimed at deterring potential importers by implementing extensive administrative requirements and bureaucratic paperwork in relation to such transactions. Multinational companies who wish to expand to countries in which significant trade barriers exist are forced to find ways to bypass them. A potential way of avoiding trade barriers, which is often welcomed by the government of the target country, is locating production facilities directly in that country. While some countries apply trade barriers, in many areas of the world, free international trade is promoted and encouraged. This is done primarily within free trade zones, usually set up by groups of countries located in the same part of the world. It is interesting to note, however, that free trade zones, whose members may do business and transact without barriers among each other, often impose high barriers to trade with non-member countries. In the next video we will be talking about the world's most important trade agreements and organizations which promote international trade. In this video we will continue to discuss issues associated with international trade. First, we will talk about the major trade agreements and the role which they play in shaping the international economic landscape. Next, we will present international organizations such as the World Bank and the International Monetary Fund, which provide financing to troubled economies. And finally, we will discuss the world's most important central banks and explain how they impact the global trade environment. As we already indicated in the previous video, trade agreements and common markets are international treaties entered into by countries interested in fostering international trade in a given type of good or service. Let us now take a closer look at the specific categories of such treaties which may be encountered around the world. The simplest type of such treaty is a bilateral trade agreement, in which two countries agree to eliminate quotas and tariffs in relation to all or selected goods. Examples of such agreements are the China-Australia Free Trade Agreement, also called CHAFTA, signed in 2015, or the Closer Economic Relations Agreement between Australia and New Zealand, referred to as CER. Multilateral trade agreements are similar, but entered into by a group of more than two countries. An example of a multilateral free trade is the North American Free Trade Agreement, or NAFTA, between the United States, Canada, and Mexico. When a multilateral free trade agreement is entered into by a bloc of countries located in the same geographical area, then it is typically referred to as a free trade area. An example of such area is the Commonwealth of Independent States Free Trade Area, signed by Russia, Ukraine, Belarus, Uzbekistan, Moldova, Armenia, Kyrgyzstan, and Kazakhstan. As we indicated in the previous video, trade agreements on the one hand enable free trade among their signatories and on the other typically impose high barriers to trade with third countries. Accordingly, trade agreements also act as protectionist measures against excessive imports from countries which didn't sign the agreement. There is in fact a specific category of international agreement aimed specifically at protecting the signatories' markets from international competition, referred to as a customs union. Members of such a union agree to trade freely within the union, but simultaneously set up a common external trade policy including tariffs and sometimes also quotas. Consequently, a customs union represents a higher degree of economic integration between countries than in the case of free trade agreements, where each of the countries typically adopts its own external trade policy. An example of a customs union is the Andean Community, comprising a number of South American countries: Bolivia, Colombia, Ecuador, and Peru. Single markets, also called economic communities, represent yet a further step in the economic integration of countries. Members of a single market remove all barriers to trade with each other in goods and services, including the freedom of movement of production factors, that is, of capital and labor. Simultaneously, the community also adopts a common external trade policy. The Mercosur, including Argentina, Brazil, Paraguay, and Uruguay, is an example of a single market. The most advanced stage of market integration known to date is the Economic and Monetary Union, whose member states, in addition to a shared economic policy regarding internal and external trade, also adopt a common currency. The so-called Eurozone, that is a monetary union of 18 out of the 28 countries of the European Union, is an example of an economic union, with the euro being the common currency adopted. The liberalization of free trade globally is promoted and supported by the World Trade Organization, commonly referred to as the WTO, which is an international forum where 164 member states can negotiate rules pertaining to international trade and sort out disputes regarding trade barriers. The current focus of the WTO is the finalization of negotiations in the Doha Development Round, which started in 2001, with the purpose of establishing common rules of trade between industrialized countries and emerging economies. Since the launch of negotiations, several meetings have already been held. However, no binding resolutions have been achieved yet. This is primarily due to the lack of consensus regarding protectionist measures adopted by free trade areas against other countries, particularly with regard to trading in agricultural products. As you can see, despite the constant growth in importance of international trade to the global economy, protectionism still remains a significant issue, particularly in relation to less developed countries. Let us now consider the pros and cons of the protectionist approach to international trade. On one hand, it seems obvious that developing economies wish to protect their local industries from foreign competition. In such case, adopting a protectionist stance may offer these countries time to modernize their economies in order to make them more competitive. There is a threat, however, that trade barriers will be used to protect obsolete technologies which are not expected to ever become globally competitive. From this perspective, it may be noted that foreign competition may also act as a positive incentive to the economies of developing countries, increasing the pace of their modernization. Concluding, there is no simple answer to the question of whether protecting domestic markets is right or wrong. It seems that depending on the specific circumstances and decisions of local policymakers, the protectionist approach may either help a country develop faster when applied responsibly, or, as in the case of countries led by populists, to obstruct the increase of an economy's level of competitiveness, thus hindering the economic growth of the country. Continuing with the theme of underdevelopment, we will devote the next part of the video to the intergovernmental organizations which are aimed at supporting the development of emerging economies. The first of these is the World Bank, which was established following World War II to help finance the reconstruction of economies damaged by the war. Currently, the World Bank provides financing to developing countries with the goal of eradicating poverty. The World Bank is in fact made up of two institutions. The first of these is the International Bank for Reconstruction and Development, and its primary function is the granting of long-term loans to underdeveloped countries to finance capital projects. That is, projects aimed at improving infrastructure. It should be noted that the loans are granted at commercial rates. The second constituent of the World Bank is the International Development Association, which provides loans to the world's poorest economies, aimed primarily at financing human development projects, such as education, child vaccination, as well as construction of basic infrastructure such as paved roads or bridges. Contrary to loans granted by the International Bank for Reconstruction and Development, the financing provided by the International Development Association is subject to special conditions, such as prolonged repayment terms and deferred interest payments. Another intergovernmental organization which provides financing to troubled economies is the International Monetary Fund, referred to as the IMF. The primary goal of financing granted by the IMF is to provide liquidity to countries experiencing deficits in their balance of payments in the transition period to recovery and the application of corrective measures. Accordingly, contrary to the World Bank, the IMF provides its help not only to underdeveloped economies, but to those which are not in the position to service their foreign obligations. The disbursement of IMF financing is conditional on the beneficiary's government adopting a reform action plan. Once again, the financing is granted on market conditions. Supranational institutions like the World Bank and the IMF obviously increase the stability of the global financial system. At the individual country level, financial stability is provided by central banks, who are among others in charge of issuing the local currency and regulating the level of interest rates. Taking into account that a vast majority of international trade is settled using the world's four major currencies, that is the US dollar, the euro, Japanese yen and Great Britain pound, clearly the policy and decisions of the central banks in charge of issuing these currencies have a significant impact on international trade. A central bank, also called a reserve bank, is responsible for issuing and managing the currency and money supply of a country or currency zone. In other words, central banks are the implementers of monetary policy. The Central Bank of the United States is called the Federal Reserve System, a name which is often abbreviated to the Fed. One of the primary roles of the Fed is naturally issuing the United States dollar, which is the most frequently used currency in global trade. You may find it interesting to know that the US dollar is officially used as the currency in 12 countries other than the United States, and unofficially in over 30 countries. Thus, decisions taken by the Federal Reserve regarding the supply of the dollar and the level of interest rates in the US dollar have a direct impact on the economic reality of citizens of all of these economies. As you will learn later on in this course, in accordance with the theory of interest rate parity, the level of interest rates is correlated with the demand for currencies and thus has a significant impact on exchange rates. So, taking into account that the US dollar is the currency most often used in global trade, the decisions of the Fed have an enormous effect on the prices of goods and services worldwide. The second most traded currency in the world is the euro, issued by the European Central Bank or the ECB with headquarters in Frankfurt, Germany. The euro is the currency used in the monetary union comprising 19 member states, all of whom belong to the European Union. The ECB is a supranational organization with equity owned by central banks of all 28 countries of the European Union. The primary objective of the ECB is maintaining the stability of prices in the Eurozone. This goal is achieved by means of regulating the supply of currency and using tools such as repurchase agreements called repo transactions, through which the amount of currency in the economy can be reduced or increased. The euro is not only the currency used to settle transactions in the Eurozone and the European Union. 11 local currencies of countries located not only in Europe are pegged to the euro, which means that their monetary authorities de facto follow the monetary policy of the ECB. The Japanese yen is the third most important currency used for invoicing in global trade and is issued by the Bank of Japan with headquarters in Tokyo. The fourth most important currency traded globally is the Great Britain pound, called the pound sterling. It is issued by the Bank of England, which was established in 1694 and is the second oldest central bank in the world, with the first place belonging to the Swedish National Bank. As you can see, the international economic environment in which multinational companies conduct their business is complex, and includes on one hand multiple free trade agreements and areas adopting protectionist approaches to international trade. On the other hand, there are supranational organizations such as the WTO struggling to eliminate major barriers to trade. Finally, there are also central banks issuing currencies used to settle international transactions. This complexity of the international economic landscape gives rise to numerous risks faced by multinationals in their international operations. We will be examining these risks in further modules of the course. Meanwhile, in the next video, we will be talking about global financial markets, which allow for the financing of international trade operations. Welcome to the course module, in which we will be discussing the issues associated with business and financial strategies as they relate specifically to multinationals. As you will know from previous modules, the financial strategy of a company has to address certain areas, such as financing structure, dividend policy, and management's approach to dealing with risks inherent to the company's business. In this module, we will extend the list of key areas addressed by a financial strategy to include those which result from an organization's international activities. Those areas in particular relate to compliance with national governance regulations in the countries where the company conducts its business, implications resulting from the international mobility of capital, managing risks specific to a given location, and addressing agency issues in a multinational capital group. When a company decides to do business in a different country, it should take into account the necessity to conform with that country's local regulations, which may potentially be different from the ones prevailing in its home market. The specifics of local regulation may impact a foreign company entering the local market in many ways. Examples of regulatory measures, which usually differ among countries, are the admission criteria which a company has to meet in order to be listed on the local stock exchange, laws governing situations in which dividends may be paid out and remitted to head office, tax regimes, and other. In any case, it is essential that a company understands the impact and implications of local regulation on its functioning in an overseas market. The increase in the mobility of capital observed globally may help a company avoid certain negative consequences of national restrictions, for example, thanks to the possibility of obtaining financing and paying dividends in the most favorable locations in terms of regulatory environment. It should be mentioned, however, that switching activities among countries may additionally expose a company to foreign exchange risk. Aside from regulation, there are also other risk factors linked to a company's presence in a foreign market, the so-called local risks. Probably the most important of these, and also the most difficult to manage, is political risk, defined as the risk of incurring losses arising from actions taken by the government of a host country or its people. Political risk may actually materialize in many ways, and in this video we will only present selected examples. One of the most drastic cases of political risk is the risk of business confiscation. That is the risk of the parent entity losing control over its assets in a foreign country. Such confiscation may be caused by several factors, including a change of government, revolution, or military intervention. It is thus crucial that a company carefully examine the political stability of a country considered as a target for expansion, including its recent history as well as its relationship with neighboring states. Another type of political risk is the so-called commercial political risk, which occurs when a political change in the host country significantly impacts its economic and business environment. An example of such event is the implementation of subsidies to local producers, lowering the competitive position of foreign companies and, in severe cases, forcing multinationals to abandon their foreign operations. Political risk may also encompass financial restrictions imposed by the local government on foreign businesses. These may, for example, be restrictions on the remittance of dividends and the repatriation of capital, limitations on access to local borrowing markets, or penal taxation imposed on transactions with other group members. Finally, political risk may also appear in the form of exchange controls, for example, restrictions related to transfers in foreign currencies or a ban on foreign currency intra-group lending. As we have already indicated, political risks are difficult to manage as their sources may appear suddenly and are often difficult to predict. Potential ways of minimizing the impact of political risk include careful observation of the political situation in a host country and being prepared for potential changes. Certain risks associated with limitations on the remittance of funds and exchange controls may to some extent be minimized through transfer pricing, and we will be expanding on this point in further modules of the course. Other implications of setting up foreign operations with the potential to adversely impact a multinational company's performance result from agency issues. In the context of international business, agency problems arise when local management promote their own interest, placing it above the interest of the organization. Factors which increase the likelihood of agency issues are cultural differences, language barriers, as well as different time zones in which the subsidiaries and head office operate. A potential solution to agency issues is stringent control over the management of subsidiaries or the appointment of expatriates as top management. This solution, however, may negatively impact the motivation of the local team, which, thanks to its knowledge of the local business environment, may potentially be more effective in directing certain tasks. Managing agency issues in a multinational company is therefore about balancing between central control and local autonomy. Aligning the goals of a subsidiary with the strategy of the parent organization requires the implementation of suitable corporate governance policies and procedures, application of appropriate management compensation packages, as well as promoting a sound code of conduct. As you can see, the formulation of a business and financial strategy in a multinational organization requires taking into consideration specific factors and risks associated with the political and cultural circumstances of the host country. In the next module of the course, we will discuss approaches applied by multinationals to formulating dividend and reinvestment policies. We will also discuss issues associated with setting up transfer prices for goods and services. Welcome to the course module devoted to the dividend policy of multinational companies. In this video, we will extend the information on dividends, which you should remember from earlier modules, with aspects specifically associated with the international activities of companies. We will also explain how multinationals actually go about assessing their dividend capacity. Finally, we will present the reinvestment strategies most commonly applied by multinational organizations. In the second video of the module, we will shift our attention to the issue of transfer pricing and discuss its role in the facilitation of capital flows among the entities in a multinational group. In earlier modules of the course, we discussed the basics of dividend theory, as well as commonly applied dividend policies. As you may remember, the primary goal of a company's dividend policy is the maximization of shareholder value. Accordingly, the formulated dividend policy should address the preferences of shareholders who may favor current cash payments to future gains from profits reinvested into projects with positive NPV. You should be aware that the shareholders of many multinationals include institutional investors, for example, investment and pension funds, which may have a strong preference for regular dividend payments. The dividend policy of such companies will therefore involve paying out a stable or rising dividend per share. Such an approach is not only in line with the expectations of shareholders, but also helps avoid the dividend signaling effect thus stabilizing the share price. Apart from the need to satisfy shareholder expectations, the dividend policy of a multinational company must also address the issue of intra-group dividends, which allow for the repatriation of profits from subsidiaries to head office, enabling the transfer of funds within the group. In this context, the list of factors influencing the dividend capacity of a multinational company must be extended to encompass so-called blocks on the remittance of dividends, which may be enforced by the government of a host country in which the company has a subsidiary. Blocks on remittance are typically, if in place, exchange controls or limits on the transfer of dividends to the parent company. For example, through legal restrictions on the dividend capacity of companies. Multinational companies are obviously interested in avoiding such administrative limitations, and several ways exist for achieving this in practice. The most widely used method to bypass blocks on remittances is referred to as transfer pricing. Under this approach, the prices for which goods and services are purchased and sold among group entities are set to such a level that profits are reported at head office or by subsidiaries located in those countries where there are no restrictions on the remittance of funds or where the tax regime is more favorable. Other means of avoiding remittance blocks include using intercompany loans. For example, a subsidiary may, instead of paying a dividend, grant a loan to the parent. The parent may also impose additional fees and charges on its subsidiaries, such as royalties for using trademarks, patents, or for providing consulting and management services, which will be settled within the transfer pricing system. Finally, the parent company may also charge its subsidiaries with various overhead expenses. You should appreciate that all of the ways to avoid remittance blocks which we have mentioned are in fact variations of the transfer pricing approach. We will be explaining the issues associated with transfer pricing in more detail in the next video. Let us now consider how a multinational company actually calculates its dividend capacity. As you know, dividends are paid out when a company is profitable, that is, when it generates free cash flows which are not reinvested. In the case of multinational companies, gross free cash flow is computed as the company's operating cash flow plus dividends received, less interest paid on debt financing and less income tax. Please note that gross free cash flow, as we have just defined it, does not take into account any reinvestments such as capital expenditure or funds required for the acquisition of other entities, nor does it consider potential increases of capital. When we do incorporate these items into the gross free cash flow formula, we come up with the so-called net free cash flow to equity, representing the amount of money which may be paid out to shareholders within a year, in other words, its dividend capacity. Net free cash flow to equity is calculated as gross free cash flow minus capital expenditure and acquisitions, plus any proceeds from the disposal of subsidiaries and new capital issued. As you can see, the formula may easily be applied using information found in a company's financial statements. Investors may thus use the formula to compare the net free cash flow to equity with the level of dividends actually paid out by an entity. Let us now discuss how multinational companies manage their free cash flows in the context of reinvestment and capital reconstruction. A reinvestment strategy may be perceived from two perspectives, that is, in the short and long term. Short-term reinvestment requirements stem from the need to maintain a level of working capital necessary to pursue the company's business activities. For example, a company may need to maintain a given amount of inventories in order for its operations to function smoothly. It will therefore reinvest a portion of its gross free cash flows to supplement inventory purchases. Thus, in the short term, the reinvestment strategy results from a company's ordinary course of business and is typically stable over time. On the contrary, long-term reinvestment strategy is associated with the pursuit of new investment opportunities, such as capital expenditure or new acquisitions. Such reinvestments significantly reduce dividend capacity. Accordingly, before making any reinvestment decision, management must convince shareholders that the future gains from the reinvestment of profits will exceed the value of cash dividends, which the shareholders will have to sacrifice. For this purpose, management typically presents shareholders with the results of an investment project appraisal, indicating the expected NPV of the project as well as forecasts of future profitability. Some companies decide to reward their shareholders with scrip dividends, where the dividend payout is realized in equity instruments. Consequently, investors have a choice of either to maintain the shares received and thus realize gains from the reinvestment, or sell the shares in the market. Irrespective of the decision made by shareholders, the free cash flow is retained by the company. Please note that capital expenditure investments and acquisitions sometimes require not only that the company refrain from paying out dividends, but that it also increase its capital by means of issuing new debt or equity instruments. You should also be aware that there are instances of reinvestments where the NPV of the project is actually negative. This will often be the case when the company is obliged to comply with new regulatory requirements, for example those related to environmental protection or waste emission. Let us now analyze the impact that capital reconstruction programs have on free cash flow and dividends. For this purpose, we will define capital reconstruction as a major change in the capital structure of a company, both relating to equity and debt. Let's start with changes resulting in the lowering of a company's equity through a share buyback scheme. As you know, a share repurchase offers a practical alternative to the payment of a cash dividend, and is performed when a business has accumulated a large amount of cash, which it cannot effectively reinvest. When a company buys back its own shares in the market, its free cash flow is reduced immediately. However, as a result of the total number of shares decreases, and the level of free cash flows which will be generated in future periods, as measured on a per share basis, may in fact be higher than before the repurchase. Accordingly, a share repurchase scheme may potentially lead to a future increase in the level of dividend per share. Let us now consider the impact that an increase in capital will have on the company's free cash flow and its dividend capacity. A capital increase may occur as a result of issuing new debt or equity. Clearly, when new debt is issued to finance working capital or new investment projects, then free cash flows in future periods will decrease by the amount of interest payable on the new debt. Please note, however, that the proceeds from new debt may also be used for other purposes, for example, financing a share repurchase. In such a case, the funds will immediately be distributed to shareholders. Nevertheless, future interest expenses will still reduce dividend capacity in subsequent periods. As we indicated earlier, investment projects may be financed by issuing new shares. In such cases, the total number of shares to which a dividend will be paid increases, which may lead to a fall in the level of dividend per share in future periods. In the previous video, we learned that transfer pricing is commonly used by multinational companies to facilitate the remittance of funds from subsidiaries to the parent company within an international capital group. In this video, we will deal with the topic of transfer pricing in more detail. First, we will explain the basics of transfer pricing and discuss its objectives from the perspective of a multinational company. Then we will explain the transfer pricing systems and mechanisms which are typically applied by organizations. We will also explain the application of transfer pricing in the context of specific tax regimes and discuss why companies locate their businesses in so-called tax havens. Finally, we will provide examples of the application of transfer pricing to eliminate the consequences of restrictions such as tariffs and exchange controls. In the final part of the video, we will discuss ethical issues associated with the use of transfer pricing. As you know from the previous video, transfer pricing is an approach used by companies to circumvent restrictions related to the repatriation of profits from foreign subsidiaries to the parent company. In fact, transfer pricing may serve more purposes. Among the most often quoted is the avoidance of excessive charges such as taxes, duties and tariffs. By transferring profits to countries with more favorable fiscal regimes, transfer pricing also enables companies to manage the final consumer price of their goods in foreign markets, thus increasing their level of competitiveness. Last but not least, transfer pricing may be used as a tool in managing foreign exchange exposures resulting from operations located in different countries. You should be aware that transfer pricing is not limited solely to the purchasing and selling of goods between the parent company and its foreign subsidiaries at predetermined prices. The term transfer pricing is typically also used to describe such practices as charging subsidiaries with royalties, overheads and other expenses, invoicing subsidiaries for services rendered to them by the head office, such as human resources management or IT services, as well as using intercompany loans to take a look at the general rules governing the practice of transfer pricing. The most important component of a transfer pricing system is setting up the levels of prices which will be used to settle intra-group transactions. The unit transfer price is typically equal to the variable cost incurred by the entity supplying a given good or service, plus the opportunity cost incurred in association with selling that good or service internally. So the opportunity cost is the contribution that the company lost by not selling the product externally, or the opportunity cost of using the company's production capacity to produce goods for internal transactions instead of using it for commercial purposes. In light of the above observations, the transfer price will range from an amount equal to the standard variable cost of the production entity when there is no external market for the goods and no alternative and more profitable use for its production facilities, to the market price when the goods or services subject to intra-group transactions are marketable. In order to function properly, the transfer pricing system of a multinational company should be understood by the management of all participating entities and should be relatively easy to operate. For companies facing frequent organizational changes, it is also vital that the transfer pricing system is flexible. In any case, it must be properly aligned with the overall business strategy and methods of performance assessment of the entities participating in the system. Otherwise, application of transfer pricing could have an adverse effect on the productivity and motivation of management at the subsidiaries. There are three most commonly applied transfer pricing systems, depending on the main transfer prices. The first of these is the market-based system, in which prices used for intra-group settlements simply reflect market prices. It is important to note that market-based transfer pricing is generally approved by tax and customs authorities in jurisdictions worldwide, as it facilitates the fair sharing of profits between entities in a capital group. Under a market-based system, income taxes and other burdens are also split within the group. The main difficulty associated with application of the market-based approach is that prices for the same goods and services may differ across geographical locations, for example due to different levels of local taxes. Prices are also highly dependent on fluctuations in foreign exchange rates. Therefore, in the case of many goods and services, there is no single market price that could be applied and approved by tax authorities across the jurisdictions where transfer pricing is in fact applied. Cost-based transfer pricing exists in two variants. The first is full cost pricing, where the transfer price takes into account all costs incurred by the production division. As a result, full cost pricing ensures that the authorities in all locations participating in the system receive their appropriate share of taxes and duties. Accordingly, full cost transfer pricing is also accepted by tax authorities across various jurisdictions. On the opposite end of the spectrum is the variable cost approach, which is generally not accepted by the financial authorities of supplier countries. This is because when suppliers only receive compensation equal to the variable cost incurred, then all profits are allocated to the receiving company, that is typically head office. As a result, production subsidiaries avoid paying local income taxes. Aside from market-based and cost-based pricing, there is also a third type of transfer pricing system which is based on negotiated prices. Under this approach, prices used in intra-group transactions are subject to negotiations, which may make it difficult for companies to take advantage of differences in tax and duty rates across various locations. As we have already said, transfer pricing may help minimize the capital group's overall tax burden. This can be achieved by reporting high profits in countries with low income tax rates and avoiding reporting profits in countries with high income taxes. In terms of transfer pricing, this means setting transfer prices in such a way that higher costs are generated in locations with high tax rates, or by invoicing entities located in such jurisdictions with services provided by entities situated in countries with low tax rates. You should be aware, however, that tax authorities in many countries require companies to provide evidence that the prices used in transactions with related entities are obtainable at arm's length, and as a result, a simple increasing or decreasing of transfer prices seldom allows for the effective transfer of profits within a group. Companies attempt to circumvent local regulations by transferring goods and services for which external market prices are unavailable. An alternative solution involves creating distribution centers in low-tax countries and transferring products to them using low prices. As a result, the whole margin on the consumer price is generated in the country with lower tax rates. Certain countries, called tax havens, purposefully lower their taxes in order to attract foreign investors. From the perspective of multinational companies, locating subsidiaries in tax havens is an opportunity to reduce their overall tax liability. A tax haven may be described as a country where many foreign companies and financial institutions function, but there are few or even no production operations. Accordingly, most subsidiaries of multinational companies located in tax havens are intermediaries or entities involved in intra-group lending operations. Aside from low income tax rates, the typical features of a tax haven include low taxes on dividends paid to overseas entities, low political risk, lack of exchange controls, a high level of bank secrecy, and comprehensive tax agreements with other countries. The most known tax havens located in Europe are Luxembourg, Liechtenstein, and the Channel Islands. Examples of American tax havens are the Bahamas and Cayman Islands. Let's now analyze how a multinational company may apply transfer pricing to circumvent burdens resulting from regulations imposed by local governments. We will start with tariffs. An import tariff is a form of duty levied on goods imported from other countries. Tariffs are typically expressed as a percentage of the value of imports. Obviously, the implementation of tariffs will impact a multinational company whose subsidiary is an importer. A potential strategy to minimize that impact is to lower the transfer price for the goods being imported. Please note, however, that a side effect of lowering the transfer price will be a higher level of profitability achieved by the subsidiary, which may stand in opposition to a strategy of minimizing the tax burden. Other types of local regulation which may impact transfer pricing policies are exchange controls. A variety of measures exist that the government of a country may adopt in order to limit the purchasing or selling of foreign currency. Restrictions may relate both to the country's residents and non-residents. From the point of view of multinationals, exchange controls represent a severe problem because they significantly hinder the remittance of dividends. A typical way to avoid exchange controls involves limiting the profitability of subsidiaries which are subject to such restrictions, for example by charging them with royalties or management fees. In some cases, however, local authorities extend exchange controls to cover such payments as well, for example by blocking all remittances to parent companies. Governments of local countries may also implement anti-dumping regulations, under which goods and services cannot be sold at prices lower than their cost of production. The goal of such regulation is to eliminate unfair competition from foreign entities, which potentially may, thanks to using low transfer prices, sell their products at prices lower than those of competitors in order to gain market share. So, anti-dumping laws are in fact means used by local governments to protect the local market. From the perspective of multinational companies, anti-dumping regulations are thus a significant restriction to adopting a fully flexible transfer pricing policy. The above examples of regulation indicate that the perception of certain transfer pricing practices by the governments of host countries may be negative. Indeed, application of transfer pricing is subject to certain ethical issues. Among these, the most important is the social responsibility of multinational companies, whose tax avoidance may be perceived as contributing to poverty in underdeveloped economies. Thus, irresponsible transfer pricing policies may be a source of bad publicity and reputational losses for the company. The process of setting up a transfer pricing policy must therefore include not only an analysis of the impact of the policy on financial performance, but also on the general wealth of all stakeholder groups, including the societies of those foreign countries in which the group conducts its business.